Alright, welcome to another weekly S&P 500 chart storm walkthrough, and this is for the 4th of March 2018. Just before we get into it, what this is a quick run through of the charts from the weekly chart storm that I do on @Callum_Thomas on Twitter. This is something I do weekly, and basically gonna just run through these and add a little bit of extra comments and context and explanation. So let's get straight into it. First one is this one. A lot going on in this chart. So we'll start at the bottom actually. So we've got here the VXV. That is actually the index for 3-month VIX. So 3-month VIX futures index, and that's in contrast to the VIX, which is the SIBO VIX index, and that's basically spot. So when we're looking at these two, we're basically looking at spot versus futures, and up here, this really noisy looking spiky line here is the ratio of the two. So it's the ratio of the futures to spot, and I put the ratio as futures to spot to sort of line it up with the index more intuitively. Basically, when you get spikes down in this indicator, or collapses in the indicator, I suppose you might call it, it's when the spot VIX heads, up rapidly relative to the futures VIX. So, if you think of the VIX futures as kind of like expectations of where, the VIX is going to be 3 months' time, if spot is higher than the future, then that's kind of indicating, more near and pressing fear in the market. And if it means fear, then, one thing that we've kind of, it's almost become conventional wisdom now, but, it's still very hard to implement sometimes, is that, the conditions of fear are usually when the market is bottoming. So you can see when this index is sort of collapsed down or spiked, it's often coincided with, well, it's been near a market bottom, so it's, there's definitely any exceptions around this, but, as a short-term timing tool, it definitely has some merit. So that is chart one, and this will kind of fits quite well with a few of the other charts we're going to be talking about. On to number two from Tom McClellan, definitely a very worthy follow on Twitter there, so you can see his profile there. You can click through. I'll put a link to this. What we're looking at here, actually, just should mention that, is the Twitter moments view, and so I put them into this. It's kind of useful for this kind of thing where you're running through them all at once. But I do also do a write-up, which I add a little bit more in the writing, and I also put that into the YouTube information section, so you can look at that too. Anyway, this one, you can see it's very similar to the previous chart, but showing you, I guess, instances where the spot was not only higher than the 3-month, but higher than all futures contracts across the curve. And again, yeah, as you can see that this signal has lit up around a lot of short-term market bottoms. I guess if you compare the 2015 correction to the one that we're now going through, there's some parallels there, in that the signal will light up and stay lit up even though the bottoming process takes some time to fully play through. And on to number three. This is a favorite of mine. It's my alternative view of volatility, and the red line is a 12-month rolling count of daily percent changes exceeding 1% plus or minus. So if day one was plus 1.2% and day two was minus 1%, that's two days that are going to be added to this count. And you can see there that we've gone from a 50-year low back in January to now as low as 96. So it's definitely what you would call a turning point. It's quite rare, I mean, if you look back across this chart, that it would turn up like this and go back down. So that's why got a reasonable degree of conviction in calling that a turning point. And then, you bring in some of the macro backdrop data or themes, trends, such as the turning of the tides in monetary policy. I mean, the Fed I think they've done around 50 billion now of quantitative tightening. Still small potatoes versus when they were running purchases around 85 billion a month, but it's experimental ground that we're in on quantitative tightening, and you know, quantitative easing was a force for suppression of volatility. So tightening is going to be something that's going to reinforce that turning point. And again, another kind of similar view here. We've got the SIBO VIX again, CBOE, and in the black line, and in the red line we have the cross asset implied volatility indicator, which is looking at bond market volatility, currency market volatility, and commodities. And it's averaging across the various currencies and averaging across the various commodities. It's one of my own that I've designed, one that I've added to the big collection of indicators across the years. And really interesting there. Oh, by the way, these are Z-scores, so they're standardized across the period. Z-score is latest observation minus average divided by standard deviation. It's just a good way to put things on common comparable terms. And you see there that the red line, the cross-asset volatility, reached a pretty extreme low point there and has turned up. Not really decisively turned up in that it's come back a bit, but again, it kind of lines up with that the theme, the macro themes that I think are going to be, confluencing to drive a change in the volatility regime. And the last one, which talks about the VIX or volatility, is this interesting one here called the common sense indicator. And this is dividing the S&P 500 by the VIX. Now, some people would probably tell you that you shouldn't be doing that because, it's a non-stationary series versus a stationary series. But, you can pretty easily get around that by adding in a trend line, which he has done here. And so it's Kai of Macro Technicals, another good follow there. He's got some pretty interesting charts. So there we go, Twitter. And yeah, so putting it in terms of deviation from trend, it kind of helps to contextualize it or take it from a trending series to a one where you can have a signal. And certainly looking at the standard deviations away from trend also helps. And when I first shared this, I've got the link there. When I first shared it, it created quite a bit of controversy, so we can actually have a look at that. There we go. Yeah, nothing common sense is about this. Yeah, so there's a bit of debate around that, but anyway, when it was first brought to my attention, at the time that was actually much more higher. Of course, it changes across time, but anyway, it was putting basically a sell signal, and a pretty extreme sell signal at that, and now it has neutralized fully and is looking like, I guess, as a mild buy signal there. So yeah, very interesting turn of events there. And speaking of trend lines, this is kind of an interesting take on the forward PE ratio chart here. So we've got the stock board asset. They've put a trend channel around the forward PE ratio. You can see there that it's come down to the bottom end and bounced, and I guess the implication there is that it goes higher from here. And I mean, in terms of absolute levels, you can't call forward PE ratio cheap, certainly relative to history at these levels, but it has come back. It's become a lot less expensive. So what it was about, looks like it was about 18.5 before the correction, and the low point there was almost 16. So Stocks are on sale. Stocks are on sale versus where they were, at least. And moving on to the next one, this is the S&P 500 operating earnings per share growth. And yeah, this is quite an important chart, I think, because, you know, most people have probably seen those forward earnings charts where there's been a big spike in forward earnings, and, you know, forward earnings growth has accelerated substantially, and that's down to the tax cuts. But, you know, tax cuts are going to be coming in this year, right? So this is December results that we're looking at here. So this is trailing. So what that tells you is that, you know, forget about the tax cuts and notice how earnings were already on an improving path, and, you know, 22.6% is a 7-year high in the growth rate of earnings. So, you know, if you're going through a market correction and earnings are on the decline, you know, as they were in the 2015-16 one, that's a much more dangerous environment versus, you know, if you're going for a market correction, earnings are actually accelerating, looking, you know, solid. That's, you know, cause for, I guess, at least cautious optimism, if not outright optimism. And one potential reason for optimism or pessimism, depending on whether you're flask half full or empty. This one shows you announced versus realized buybacks shared by Lance Roberts there, and pretty interesting, really. So you look at this, it's annualized, so, you know, I guess you take that with a grain of salt, because, you know, that they could change their plans for the rest of the year. But I guess it does line up with the whole repatriation of corporate funds kind of theme, and you know, lines up with what has actually been quite a big theme in recent years. Although I guess it would be quite interesting to see buybacks increase when quantitative easing's decreasing or going away, going the opposite direction. Anyway, key point or key takeaway from this chart is that it looks like there's a whole bunch of buybacks in the pipeline, and, you know, you hold everything else equal, that just means more demand. And if you hold supply constant, you know, economics 101 says more demand, steady supply equals higher price. So that is a piece of information worth taking on board. The next one shows, very quite interesting actually, is how substantial the rise in short selling or short interest has been on junk bond ETFs. And you can see there, so it's shares that have been sold short as a percentage of total outstanding. And, you know, I guess it makes a bit of sense. For, I suppose, I mean, they were starting to pick up in the back half of January, but I guess you could almost call it a reactionary increase, in that much of the increase took place in February, which was when, you know, the correction was already underway. But, you know, I mean, throughout, I guess, the back half of last year, I've been sort of becoming a little bit wary on credit. Some of the indicators that I'm watching, you know, they're seeing a little bit of mixed signals. So if you look at where credit spreads are, they're, you know, fairly tight. They're the tightest, you know, pretty much the bottom of the range. You can call that overvalued. Yet there's some positive signals as well. So it's not like a total. It's not like I would be necessarily, you know, being aggressively net short, but, you know, credit spreads in themselves. But you look at junk bond or corporate bond ETFs, the keyword there is bond, and, you know, unless it's floating rate notes, you know, your standard corporate bond is going to be behaving the same way as a treasury bond when bond yields, generalized levels of bond yields are rising. And it's called interest rate risk or duration risk, and, you know, you're going to see capital write-downs as, you know, mark to market losses as bond yields rise. And then you throw into the mix, a slight increase in credit spreads, or really only a minor tick up in credit spreads during the correction. So, and we'll talk about a little bit more about that in the second chart, or the chart following this one. But the point is that it does make sense in the respect of expected rising yields and some mixed signals on credit that you would be short. But I guess from a contrarian standpoint, it shows you that there's some pessimism in the mix there. And the final one here is flagged is the corporate CDS pressure index. So that index looks across 17 different corporate CDS sector indexes from Thomson Reuters, and pretty much what it does is look to overweight or accentuate the any incidence of spread widening in a particular sector or group of sectors. And the reason why you would look at that or even think about using that as an early warning indicator is that if you started to see stress in one sector or a group of sectors, that could be potentially a harbinger of wider or broader spread widening. And it's interesting to call it an early warning indicator because across its history it seems to have worked as more of a coincident indicator. But when it's doing what it's doing right now, which is rising, and it's actually on the back of 3 or 4 different sectors, I think. It's you always look for divergences in financial markets. So this one, if I was optimistic, this would be the reason why I'd be cautiously optimistic instead of outright optimistic. Yeah, I guess probably the way to explain that one away, or to be able to sleep at night when you've been looking at that chart, is to think that it could be more idiosyncratic risk rather than systemic risk. And either way, it's going to be one worth paying attention to. I think high yield credit jump bonds I think they're always worth paying attention to. It's something that I watch quite closely. It's a pretty key asset class for asset allocators. So of course it's on my mandate. But and how it relates to the stock market is pretty key through 2 channels. So the funding channel, because corporate credit spreads or absolute levels of corporate bond yields obviously has an impact on the trade-off between equities and bonds. It also has an impact on corporate finances, and of course credit spreads themselves also reflect risk sentiment and play into the risk appetite backdrop. So I will leave it there. If you had any questions about these charts, or indeed if you wanted to submit a chart for a future edition, definitely put that in the comments below. And otherwise, just make sure that you subscribe to the channel so that you don't miss any future updates.